The Indian equity market has been on a steady downtrend since late September last year, and the weakness has extended into 2025. However, this correction is not limited to the benchmark index alone. Broader markets and several sectoral indices have also taken a significant hit. One of the worst hit sectoral indices is the Nifty Real Estate Index. The Nifty Realty Index has plunged since the start of 2025, making it one of the steepest declines among sectoral indices. The correction in the real estate sector comes after a period of robust performance, 36% CAGR from 2020 to 2024. But after reaching its 52-week high in June 24, the index has now fallen as of March 2025. So what's driving this sharp decline? The downturn in the Nifty Realty Index can be attributed to multiple factors, including housing sales, the slowdown in project launches, demand-supply dynamics, and overall market conditions. According to analysts, new project launches remain subdued across major developers in the past few quarters, including Q3 of FY25. This was primarily due to approval-related delays. With low inventory levels across the industry, this slowdown in launches has had a direct impact on bookings. That said, the ongoing shift towards a premium housing helped offset this decline as higher realizations drove strong pre-sales growth. However, the real estate sector's correction has been much steeper than the broader equity market, raising concerns about whether the real estate boom is coming to an end. Does this signal trouble ahead for the sector? Are we looking back to a period of rising inventory levels and stagnant demand, just like in the pre-COVID decade? Well, let's break all of this down in today's episode of Bottomline by Groww. My name is Radhika Bajaj. Between May 2019 and May 2024, the index delivered an impressive return of 32% CAGR over the 5-year period. The real estate sector has faced significant challenges in the past, ranging from high inventory buildup and stagnant growth to affordability concerns, project execution delays, and even fraudulent practices by developers. However, the landscape has changed dramatically in recent years. The easing of the liquidity crisis since 2016, the introduction of RERA, the Real Estate Regulatory Authority, rising residential demand, new project launches, and improved industry practices have transformed the sector. So while the current correction may suggest that the real estate sector is slowing down, indicators suggest that it could still be poised for continued growth in the coming years. Let's start with the basic indicator: robust housing sales, strong new launches, and lower inventory levels. Since the lows of 2020, the Indian real estate sector has staged an impressive comeback, marked by record-breaking new launches and strong sales growth. In 2022, new project launches surged to their highest level in a decade, surpassing all previous records since 2012. The momentum carried into 2023, when housing sales hit an all-time high, reflecting a strong appetite for home ownership. But for the full year 2024, there is a slight dip in sales and new launches as per a prop equity report. Now, this dip is not concerning and is mainly due to general elections and an extended monsoon season. The ratio of housing supply to sales for 2024 remains healthy. That said, one of the most telling indicators of market strength is inventory overhang, the time it would take to clear unsold housing stock at the current sales pace. Since 2017, sales have consistently outpaced new launches, leading to a steady reduction in excess inventory. From a peak of 3.3 years in 2017, the inventory overhang fell to 1.5 years in 2023. That's the lowest level since 2011. In real estate, inventory refers to the number of unsold housing units, whether it's commercial or residential. Inventory overhang, on the other hand, indicates the time required to sell these remaining units. By the end of 2024, it remains stable at 1.5 years, signaling a healthy balance between supply and demand as per prop equity data. Several factors have contributed to this robust recovery since 2016. One key driver has been renewed home buyer confidence, fueled by regulatory reforms such as RERA, GST, and demonetization. These measures have brought greater transparency and accountability to the real estate sector, restoring trust among buyers buyers and investors alike. Now, another major shift has been in home buyer preferences, particularly in the wake of the COVID-19 pandemic. The desire for home ownership has strengthened, with buyers increasingly opting for larger living spaces, premium and luxury housing units. The average unit size sold has also increased post-2020. Additionally, the share of physical assets, excluding gold and silver, in household savings has risen sharply, reaching 70% in FY24, up from 57% in 2016-2017. This trend was particularly visible after the COVID-19 pandemic. As a result of these structural changes, inventory overhang has now fallen to just 17 months, one of the lowest levels, and it continues to improve. Another factor is improving home affordability. The real estate sector is witnessing strong demand from both end users and investors, driven by favorable economic conditions and evolving market dynamics. Additionally, the Indian government's push for housing for all through affordable housing schemes and infrastructure development has further supported this growth. The end user demand, that is, demand from home buyers, is being fueled by improving home affordability, supported by healthy salary growth, steady job creation in white-collar sectors, and stable mortgage rates. According to Knight Frank research, housing affordability has improved significantly over the years. The Housing Affordability Index, measured as EMI to household income, has shown a marked decline since calendar year of 2010, making home ownership more accessible. In Mumbai, for instance, the affordability index has improved to 50% in calendar year 24, down from 93% in calendar year of 2010. Similarly, in NCR, the index has dropped to 27% from 53%, and in Bengaluru, it has fallen to 27% from 48%. Furthermore, the property cost to annual income ratio stands at 3.3 times as of FY23, compared to an average of 3.7 times over the last decade, making this the most affordable housing market. You might wonder how housing can be considered affordable when it remains expensive for most middle-income individuals. This could be because many so-called affordable units are actually targeted at premium and luxury segments where income growth is higher among certain individuals. As a result, housing becomes more affordable for a select group rather than the broader population. Given India's diverse population, where the majority falls into lower, middle and upper middle income groups, where affordability for houses is largely driven by tax incentives, redevelopment project benefits and government schemes. After all, affordability means different things for different income groups. Also, India's household balance sheets also remain strong, providing further support for housing demand. The country's household debt to GDP ratio stands at 42.9%, significantly lower than other emerging markets like China, where it's at 64%. In developed economies, this number is at around 69%. Additionally, India's low mortgage penetration, with a mortgage to GDP ratio of about 12% compared to emerging markets like China and developed markets like the US, indicates ample room for future growth in the housing finance market. Mortgage to GDP ratio means outstanding mortgage loans in a country relative to its GDP. It serves as a key indicator of the housing market's vitality, reflecting the level of mortgage debt in proportion to the nation's overall economic output. With strong affordability, increasing incomes and untapped mortgage potential, the Indian real estate sector remains well positioned for continued expansion despite recent market corrections. That's why there is a higher demand for premium and luxury housing segments compared to the mid-range and affordable housing units. As such, in recent years, real estate companies have gained better in terms of sales and profitability, aided by a focus on luxury and premium segments, price hikes leading to better realizations. This is despite a slower growth in the volumes. For instance, take Macrotech Developers Limited. The company's management has made a conscious effort to shift towards the premium and luxury housing segment to capitalize on the market. Similarly, another listed company, Mahindra Life Spaces Developers, mentioned that they have been focusing more on the premium and luxury housing segments since December of 2024. Brigade Enterprises is another company whose management is focusing on building housing units in this segment that is seeing a lot of demand, which is of course the premium and luxury segments. At the same time, investor interest is on the rise, backed by robust property price appreciation and improving rental yields. There are other data pointers too that are expected to keep the sector steady in the coming years. To begin with, India's urbanization rate remains low and continues to be on an upward trajectory. industry. Then there's India's urban population, which is estimated to see the highest growth during calendar years of 2023 to 2035. India also ranks high on the share of working age population, and India is projected to achieve higher GDP growth in the next 5 years versus its peers. All of these pointers indicate higher housing demand as India and its urban population keep growing. There's also the interest rate cycle and the real estate sector. Historically, real estate sales have shown a negative correlation with interest rates. Housing demand typically accelerates when interest rates decline. However, over the past 2 years, sales have remained strong despite rising or stable interest rates. This resilience has largely been driven by the high-end premium and luxury segments, which are less sensitive to interest rate fluctuations. In contrast, growth in the affordable housing segment has been subdued due to the impact of rising borrowing costs. The Reserve Bank of India is expected to continue easing rates. The first of these rate cuts was done in the February 2025 monetary policy meeting with a cut of 25 basis points. Many economists expect an additional 50 basis points reduction during the rest of the year. This anticipated rate cut cycle is particularly positive for the affordable housing segment, which has lagged behind the premium and luxury markets in recent years. As borrowing costs decline, affordability will improve, unlocking pent-up demand in the segment. A revival in affordable housing, coupled with sustained strength in premium sales, could further accelerate the already strong momentum in India's real estate market. One of the most significant trends shaping the real estate sector is the consolidation among developers. As per analyst reports, over the past 10 to 12 years, the market share of the top 10 developers in new launches has increased from 7 to 8% to 23%, while their share in overall absorption has risen from 8 to 9% to 15%. This shift indicates a growing preference for trusted, well-established players driven by better execution, regulatory compliance, and improved financial strength. Another crucial factor bolstering the sector is the declining leverage levels among major listed developers. Over the years, these companies have strengthened their balance sheets, giving them greater flexibility for business expansion, new project acquisitions, and commercial capex during growth cycles. For instance, Godrej Properties, one of the largest realty players in the industry, has brought down its net debt to equity ratio from 1.2 times in FY15 to 0.6 times in FY24. As such, the overall industry's level also came down from 0.7 times to 0.3 times during the same period. Their improved financial position allows them to better navigate potential slowdowns, ensuring stability in the industry. A particularly notable trend since COVID-19 has been the rising share of luxury housing in overall sales. This shift has resulted in higher average realizations, while construction costs have remained broadly stable, boosting overall industry profitability. Additionally, key wealth creation indicators point to sustained demand for premium housing. Factors such as a growing high net worth individual population, strong capital market performance, and a thriving startup ecosystem continue to drive upgrade demand, further reinforcing the sector's long-term growth prospects. So that's a comprehensive view of the current state of affairs in the real estate sector in India. In conclusion, while the real estate sector's fundamentals remain robust, only developers with solid financial health, a strong launch pipeline, and sound business strategies will be able to consistently deliver value to their investors. Hope you learned something new from today's video. Do subscribe to the channel if you want to continue being informed about the markets and broader trends. Do you, by the way, have any real estate companies in your portfolio? Let us know how they have performed in the comments below.